Hello, and welcome to the Think Big for Business channel. If you haven't done so already, please click on the bell button and subscribe to the Think Big for Business channel. That way, you'll receive notifications when we release a new video. In today's video, we will be talking about the rise of bank failures in 2023 and how they affect your money. This is a pressing issue that we all need to be aware of. So let's dive in. Before we begin, let's start with some basic definitions. A bank failure is when a bank is unable to meet its financial obligations to its customers and creditors. When a bank fails, it can have a ripple effect on the entire economy, and customers may lose their deposits. In 2023, we have already seen the collapse of Silicon Valley Bank, which was a key financial partner for tech companies in Northern California. We also saw that Credit Suisse, a leading Swiss bank, was facing financial trouble and was bought out by UBS. This trend is worrying, and it begs the question, is your money safe in the bank? To answer this question, we need to understand how the banking system works. Banks are insured by the Federal Deposit Insurance Corporation, FDIC, which means that if a bank fails, the FDIC will step in and reimburse the depositors up to a certain amount. This insurance is designed to protect consumers and ensure that their money is safe even if the bank fails. However, there are some limits to FDIC insurance. The standard insurance amount is $250,000 per depositor, per insured bank, for each account ownership category. So, if you have more than $250,000 in deposits at a single bank, you may not be fully covered if that bank fails. It is important to understand these limits and to spread your deposits across multiple banks to ensure that your money is fully protected. Now, let's talk about why bank failures are on the rise. One reason is the COVID-19 pandemic, which has had a significant impact on the economy. Many businesses have closed, and many people have lost their jobs, which has led to a decrease in lending and an increase in loan defaults. This has put pressure on banks' balance sheets, which has led to an increase in bank failures. Another reason is the deregulation of the banking industry. Since the financial crisis of 2008, there has been a trend towards deregulation, which has allowed banks to take on more risk. This has led to a proliferation of new financial products and increased competition, but it has also increased the likelihood of bank failures. So, what can you do to protect your money? The first step is to make sure that your deposits are fully insured by the FDIC. You can check the FDIC's website to see if your bank is insured and to check your coverage limits. The second step is to spread your deposits across multiple banks. This will ensure that your money is fully protected and that you are not putting all your eggs in one basket. It is also a good idea to diversify your investments across different asset classes, such as stocks, bonds, and real estate. If you're concerned about a bank, take a close look at its financial statement to see if the bank is profitable and if it has a sufficient level of reserves to cover potential losses. Profitability is important because it indicates the bank's ability to generate income and support its operations. Reserves are important because they act as a cushion against potential losses from loan defaults or other economic problems. We'll put a list of the most profitable banks in the description section below. In conclusion, bank failures are on the rise, and it is important to understand how this can affect your money. While the FDIC provides insurance to protect consumers, There are limits to this coverage, and it is important to spread your deposits across multiple banks to ensure that your money is fully protected. By taking these steps, you can ensure that your money is safe, even in the event of a bank failure. Thank you for watching the Think Big for Business channel, and we'll see you in the next video.